Sir, I am Rakesh from Bombay.
Hi, Rakesh.
So I joined options in March 2020 since the lockdown. I was not aware of options, but I am slowly picking it up. I was through your site on YouTube and I was very impressed because you made it sound very simple and it was very exact. I felt nobody could, for all the videos which I have been through, your videos were exact to the pinpoint. So then, sir, I started attending your Telegram channel and followed some of your investment advice, which I personally messaged you, and I found it very helpful, sir. Thank you very much, sir. Sir, I have put some of my queries on Twitter. Uh,
Yeah.
One of them is the first one is how to identify if the prices in the stock option chain, bank Nifty option, are too expensive or too cheap, so as to decide it's a better deal to buy the option or to sell the option. We usually look at VIX for Nifty options, but for stocks as well as bank Nifty, what should be that implied volatility which we should look for? Right now, I'm blindly selling on the top, blindly selling at the bottom. It means I'm selling calls and selling out of the money puts. So I'm doing it very blindly. But I feel, is there any way to measure key, yeah, at this point of time, say this is a good time to sell? Like, I feel you have a good judgment that this looks, because in TCS I have seen you had told once that the prices were very good. That is why I made another put or another call sale. So I'm not able to determine which is a good option to short, the call or the put.
Okay.
I can understand the range at which the stock is going. So based on that, I'm selling the call and selling the put right now. But is there any way to say, okay, this is at this level, this is at this range, this is 20 days away from expiry, so this should be probably a good rate to sell? Is there something like that, or do we just sell on the momentum, whatever it is?
Okay. So I understand. So just earlier I told, right, in a simple way, to understand that when to sell or what to sell, or you mean to say that what strike to sell, either put or call, what strike to sell if you are
Yes.
if you are a seller, and if you are buyer, what strike to buy.
Yes.
Yeah, buying part may not be able to answer because I'm not a buyer side. I do not know much about buying thing, so I can explain only what I learned, what I had experienced.
Yes.
So comes to seller point of view. Yeah, I told you, right. If you have a list of companies in your watch list, what you have to know is every company treat it as your baby. Understand? You observe everything.
Yes.
Similarly, if you take an example of TCS, you know TCS must be like you must be watching TCS since like 2500. I was watching 2200 onwards. Means since the COVID sense, how it is going up, what is the quarter results, how it's publishing, what is its strength, all the things you know that you keep observing that. This is not one day or 1 month is possible that I know that about TCS. When you look at the charts, when you look at the historical way, you know that tells you a theoretical knowledge. But when you look at a company individually, observation is important. Anything. So observation is the primary factor here. If you keep observing, so TCS, right, 3,200 to all the way it went to up to 4,000. So then, after that quarter results, again it fell back to 2,600, after some time 3,500, 3,400, around some change, 50, it came down, right? So then, since we are watching that, so now you understand that a price when compared with the peers or Infosys or HCL Technologies or Wipro, it has been corrected like anything. Now it is available at a good price. Of course, we would look at the valuation part a little bit, PE size and what is the PE and all those things. Based on that, it would not go beyond that. Chances are very less because people expectation is very high from TCS, but TCS results are good, not bad. It was corrected, yeah, that's fine. That is a good opportunity correction, right? So other companies are little bit doing good, but TCS is corrected. It was punished, whatever level it went up. So now this is a great opportunity for me. Yeah, to 3,400 is there. They're better than I'll buy a few shares, or I'll short 3,400 put. If I am interested in bull put, I will short 3,500 put and buy 3,400. 500 and 400 range, because it would definitely would not go down. If it go down, if you have a doubt, if it would go down, you enter into a bull put. If you don't want to take delivery, yeah, okay, even if it goes below 3,400, I take a delivery. This is a good company. You feel that. Then what if you do? If you want to get, then you can directly short 3,400. If you are an aggressive trader, somebody would even short 3,500 put also. Because if you keep observing the company over a period of time, you get this kind of knowledge. This is a knowledge nobody can teach you, and nowhere is available on the books or internet everywhere. Your personal observation and learning is important. It's move, all those things. So based on that, you can take a call. That is about TCS. And also sector wise, you need to understand, because since COVID, sector is doing good. IT sector is definitely doing good. We all know that. And also, right, even not just don't even blindly follow this IT companies, right? Before that, Accenture is a company which would post results, which is a kind of a foreign indicator for us. I can say, local indicator is first indicator is TCS, or foreign indicator is Accenture. Because Accenture company, how it posts, what is the guidance, based on that, we can definitely take a call. Yeah, definitely Accenture posted a good result, it made a good guidance. Definitely we are the people working for Accenture, right? So then Accenture is posted a good result all at once, then definitely our IT companies must be doing very well, no doubt. So we are getting all the data available. So based on the data or knowledge, we can take a good call. Whatever I make a statement, I'll keep what is the reason, what is the why, what made me to tell these things, and obviously I'm explaining in a way whatever I learned, why I'm making this, why I'm comparing this, all those things with the data observation I keep posting. Accordingly that I take a call. That is about a strike. So this is how you need to think about that. So may you understand any other thing you want to ask on that?
No, sir. It was good. Sir, my second is, does anybody else have a query? Shall I go ahead with my second one?
Yeah, go ahead, Rakesh. Go ahead, I have no problem.
Yeah, sir, the second one is, when we go for the covered call, we are advised to hold stocks in the demat account. If instead I buy futures and start making a covered call, what is the disadvantage of this method? So quite recently you took a covered call with the futures. Just I think yesterday only you took it, sir. But sir, before I had heard that you should always have a covered. I always take naked covered calls, and I should take it at a safe distance. But I was always advised that you hold stocks. So I was a little confused. Why not if I just buy futures and make a covered call? What would be the disadvantage or the advantage of this method?
So when it talks about covered call point of view, there is hardly any difference between holding a futures or holding a cash. I mean, in terms of in a high level. Maybe if I say like that, your questions will not be answered. I'll tell you. Buying a futures is as good as holding a lot, one lot of cash holding. But you get a benefit is margin. If you're buying a futures, you spend margin of, you need to have margin of 1 lakh, 1,20,000, maybe max 2 lakh. Same stock you need to buy, you have to pay 6 lakh, 7 lakh in one shot. You need to hold the company. But what major difference is, right? If you own a stock, one lot, it's your investment. it's your money. There is no cost incurred for carry forward, right? Rollover cost and all is not there.
Yes, sir.
You need to worry about that contract level, right? Futures in India, futures is, options on futures on stocks is max 3 months time period, right? More than that, you cannot hold. You need to again roll over to next series.
Yes.
But so futures, whatever you do it comes are considered as business income, but you don't get a capital gain benefit. If you want to have a stock, that comes under capital gains, right? It could be short-term capital gains or long-term capital gains.
Yes, sir.
That is the major difference and comes to tax perspective. And margin perspective, I explained, right? Margin you would take, but future is a daily, right? Future today is give you 50,000 rupees profit. Yeah, that comes to your account. Today, if you get a loss of 25,000, yeah, that money you need to supply 25,000. Yeah. So like fall like Corona, COVID fall and happens, stock corrected to future corrected to 20,000. Sorry, corrected to 20% like that. It would take that much percent of money you need to supply. You have one future, that's okay, you can manage. That is that you have 5 futures or 10 futures. Each future cost is around like 5 lakh. 10 future in 5 lakh is a 50 lakh. So you should be able to supply 50 lakh in one day if market falls like that. If you have capacity like that to bear that much amount, obviously you can go for futures because you'll get a less margin. You don't need to put the entire money. With the remaining money, you can play more time or more trades. You can do to other trades, other stocks. You can do that. But future is advantage only with going up or mildly bearish, neutral and bullish scenario. That is okay. No problem. You can manage futures. But situation like black swan event like COVID. I mean, of course, you should not call every time because COVID and coronavirus things come once in a lifetime, right? Or once in 4 years or 5 years.
Yes.
It's not a repeated event. So people should not scared about this kind of events because by the time you will be, people would be more matured enough what to do, what not to do. So such situations arise. You should be ready that either you have to book loss or you can manage by supplying your money, shortage of money. Like that you can think and you can plan accordingly. Other main difference which is not possible with the equity, only possible with futures is equity you cannot short. In Indian market, it's not allowed. You cannot short position equity lot. Only you can buy. Futures you can short. That is the advantage. People who want to short equity, they cannot do that. But futures you can short. That is a major difference. Yeah, all other things are margin and all other things are. So those are other things I explained.
Okay, sir.
Yeah.
Thank you, sir. So the third question I had was, sir, I have a portfolio of 40 stocks in different numbers. So I was thinking of eventually month-wise removing some of them and going for lot sizes of futures option sizes or big stocks. So
Okay.
this is what I'm thinking, sir. Do you think, sir, because I want to hedge my portfolio going forward, because I was not aware of this concept, say around 3-4 months back. So I'm thinking of hedging my portfolio to whatever stocks which I have. So I'm thinking of either removing them or rounding them to futures and options lot sizes, sir. So do you think that is a good idea?
Okay. So you said your quantity is 40 stocks.
Yes.
Okay. What is your intention? Is it long-term investment or you want to generate income out of it? What is your point?
Sir, it is a long-term investment actually. But I need to be trading in options, futures and options also, sir.
Okay.
Using it as margin. And yeah. And sir, I needed some sort of, say, if there is some 20-30% drawdown happens. So there are some stocks which have a higher beta, so they fall down more. So I don't want to, I just want to keep a small amount of my portfolio in those stocks, and most in stocks like say TCS, the front runners. So at least the fall would be minimal, and okay, my returns might go down a bit, but I feel that is more safer in the long run. Sir.
Right. So understand. So number of stocks in your portfolio, generally as per my experience, is one who understand options and futures, especially options. Owning a stock is like owning a one lot. You need to consider like that. That is when you get an advantage. If you are a long-term investor, so yeah, as you said before, right? You own number one or number two at least,
Yes.
or frontliners, and average out somewhere to one lot. Because if you have one lot, that is when you have more options to manage it.
Yes.
Otherwise, suppose if you have a good stock, maybe you do not have it is not an F&O stock, right?
Yes.
Maybe let's take, I think, Tata Elxsi.
Yeah.
It's not an F&O stock, I think.
Yes.
Suppose that is a good stock, but what will you do if you want to hedge it? You cannot hedge it. No, nothing you can do. Just if you fall, if you can buy more, nothing else you can do that.
Yeah.
Right. So
Yes.
rather if you have older stock which is traded in the F&O segment, something you want to do, definitely you can do that. You can hedge it. Because
Yes.
I think in my previous video or my latest video is how to lock profits.
Yes.
That
Sir.
is a video I explained 5 methods based on investors' psychology. You can adopt one of them or few of the methods.
Yes.
So there I just explained how to hedge one stock. If you want to hedge multiple stocks, what you can do? You can buy Nifty options. Now, as of now, Nifty option 50 lot is almost equivalent to 8 lakh. Let's say you have a 80 lakh portfolio.
Yeah.
Every stock maybe you do not want to hedge. You cannot. It's not so easy. In that case,
Yes.
what you can do? You can buy 8 puts.
Okay.
Up to some level,
Yeah.
it puts, then you can hedge it. Provided that your stocks are in F&O, provided that your stocks in F&O that are in frontline or blue chips. Your
Yes.
stocks are F&O hardly just for namesake they are in F&O, but doesn't have much weightage in the index. It doesn't
Yeah.
reflect in your hedging.
Correct.
So that's how you need to plan.
Yes, sir.
Did I answer that question? Anything else I left out on that?
No, sir. It was good. It was perfect. I understood. Sir.
Okay.
I'll try to make it lot size strong. I'll start removing the small F&O stocks and go into frontliners only. And so the stocks which I need, which are small or mid sized, I'll do a small percentage of the portfolio only. I will not hedge them.
Yeah. So and also you have to think about that. If a stock doesn't move anywhere, if a stock stays there, you should be able to generate income out of it.
Yes.
You need to think that way so that you can sell a call for OTM call or whatever.
Yes.
Right? So if you take an example of Reliance Industries, almost 8 to 10 years it has been there in sideways.
Yes, sir.
For investor, it has given nothing, zero returns.
Yes.
But one who has a one lot in F&O,
Yeah.
definitely you would have made good money by selling a calls for 10 years continuously.
Yeah.
Imagine that. F&O the option itself is just giving 1%, basic 1% return per month,
Yeah.
12% per annum, which is very minimum. You would have
Yes.
gained that much amount. Simply, it doesn't care. Reliance stayed there in 10 years. It gave me no returns. No. So that's what. So investor, buy and forget investor sometimes or many times or doesn't get much opportunities.
Yes.
But when he has options, know that, then he can make money like that. Even if you ask me the example, Hindustan Unilever, I told you, right? I purchased a lot Hindustan Unilever at
Yes. Yes.
2,230 rupees.
Yes, sir.
It went all the way to 2,800 or 850.
Yes.
Somewhere I think I gave it that delivery around 2,650 or 700. Again, it came back to 2,230 rupees. Again, I purchased a lot. On lot, I'm purchasing a lot. So investor who invested at 2,230 or 2,200, he gained almost nothing. But for the past 6 to 8 months, it has given me very good returns. So again, I sold it. Again, I bought it. Still, I'm running my wheel.
Yes, sir.
That is the opportunity. So stock market is not a one direction. We know that. So we make use of that given opportunities every time.
Yes, sir.
That is thing. Huh?
No, Thank you, sir. Thank you, sir. Sir, in stocks, we usually risk 1 to 3% capital, or say I lose 10,000 or 20,000 maximum on one trade. So when we take these trades, the wheel trades, and have covered calls or secured puts, and I have say like 20 lakhs of capital margin with me. So do you have, what do you think is a good investment amount for a 20 lakh margin? Because usually what I see is if you have 20 lakh margin, people are trying to do max 20 lakhs or max 21 lakhs by hedging or etc. etc. But say in your view, if I have a 20 lakh and if I'm a conservative investor, a trader, how should I go about? How much percentage of risk should I take, say in a month or in a trade? Sir?
So you have a capital of 20 lakh or you have a capital invested 20 lakh?
Sir, I have margin stocks and liquid funds worth 20 lakhs. 10 lakhs stocks, 10 lakhs liquid funds. I have kept in liquid funds. So I, with 50% cash and 50% pledged stocks, so I'm able to take 20 lakh margin.
Okay, I understand. So yeah, so if you are a if you say very conservative investor, what you can do bet on 10 lakh. Let's say stock falls down. Let's say you have a holding or short a put of 10 lakh, 5 lakh lot. So theoretically, you can say you can short only 2 stocks, because if those 2 fall in the money, you are ready to take delivery because you have 10 lakh. That is very safe bet people would do. I mean, I used to do in the beginning. But people some aggressive way, what would they do? Even I also do like that. I know that what if stock falls below that? I don't have to take delivery. If see, that is it. I have a good stocks where I want to take delivery. There are stocks which I don't want to take delivery, but I just run the show based on the stock volatility and all. In that case, you can take a leverage more that. But if you are a beginner, I suggest that take trades as per your margin only. I mean, the entire thing. If you learn well, if you know things many things, then what you can do, you can leverage your margin and make things better. Provided that you know that, what if stock falls down, what to do, but you should be able to understand what is roll down, what is roll forward, roll up, all the things we are aware of that, then you can take a leverage of margin. So that way, based on the scaling up depends on individual thing. If you are becoming more knowledgeable, advanced, expert level, definitely people would take even complete leverage. 20 lakh leverage is there, they can take 20 lakh leverage. Right. So if you take a stocks or the trades worth of 20 lakh, all trades will not will not give you loss, right? They are not. So maybe sometimes 2% or 3% trades would give you losses. Maybe other 90% or maybe 80%, 70%, even 60-40, right? 60% is profitable, 40% loss making. Still you can manage it like that. So this is all game of a calculation. Okay, this is a very much about calculation. How you bear the loss, how you manage the loss, how you make adjustment with the money. Based on that, you can scale up.
Okay, sir.
But this makes more sense for intraday traders. I hardly do intraday, but on intraday traders they take entire margin as a collateral, whatever. Then they book the loss or profit for the day. They don't
Yes.
take overnight risk. Just leave it by the day. They do like that. They need a long margin level. For positional traders, this is how they have to grow one by one.
Okay, sir.
Yeah, this is
Sir,
good.
what I was what I was looking for is just 2 to 3% maximum 4% or 3% per month. Like that, I was looking for a strategy, fairly safe. I don't say totally safe because stock market is not safe, you know that. Fairly safe strategy, which I need some advice on this because I don't want to lose much. So about 2 to 3% only I'm looking for the returns and safe strategy. And one I came across is Ranjit
Okay.
sir. He was like he's a very good person. I learned the option wheel from him, and I'm now able to get into the option details of options. And I also made some trades. But whenever I bought options, it was most of the time it was under loss. And whenever I sold options, I made small amount of profits. And covered call is one what I'm looking for. But can you adjust the entry, exit, or any other strategy where you can looking for a very small 2 to 3% only? I'm looking a fairly safe strategy because my margin will be around 15 to 20 lakhs.
Yeah. So, Krishna, when you say 2 to 3%, that's like a upper number. 3% per month or per annum? What do you mean?
2%, 1 to 2% per month.
Per month.
With
So
about 20
2%.
lakhs left.
Yeah, 2% per month is a 24% per annum. Just to understand, right? This 24% per annum is not even bad number. It's an excellent number. So when you expect 2% is really good. That is not so easy all the time as well. That is something every one of us to understand. When everybody says 2%, they think very less. No, that is not less. Even I say 1% is also not less. That's what I want to say. That 1% itself is a very that is also risky, right? So today's bank interest is giving us like 4 or 5% per annum, and fixed deposits are giving you not more 6 to 6.5% annum. Home loan is interest charging us just a 6.5% per annum, right? So all the financial institutions are not earning even 1% as of now. So if we are able to earn 1% or 2% per month, which is really very good. If that is a target, of course, in a market, stock market, 1% or 2% return is okay. Somebody thinks that is a good decision, that is good, very well managed up to some level. So if 10-20 lakh is earning 2% is just like you can choose whichever strategy you are comfortable. Let's say you are comfortable with the option wheel strategy you learned from there. Certainly you can make 1% or 2%. That is the thing. But if you don't want to take it, that is a option wheel is good strategy, but bad is you need to have a high capital. If you don't have capital, if you are not a capital intensive trader, then option wheel may not help you much because you are going with the undefined risk strategy comes to cash secured put. Covered call, that is okay. So that is the one thing. So other things still, no, I don't want to take that much capital or risk. Then if somebody need that is where I say covered call strategy. Covered call strategy, people generally know that I should have futures or stock, and I sell a call. That is one way. But covered call strategy can be applied on the indices as well. Generally in the group I used to post that is called call calendar. People call it call calendar, but that can also be considered a covered call. Means you buy a call or deep in the money. So today market is 17,000. Go deep in the money 5% around 16,000 call. You buy 16,000 call and keep selling ATM call. So you are selling a call. You have an underlying of 1 month or 2 months expiry, like a 4-month expiry option, and you are selling ATM option. For that, it needs hardly 50,000 capital, 50,000 as a margin. If you lose in the trade, you max lose is 50,000. I mean, in real time, that's a theoretical loss. But does anybody lose 50,000 one shot like that? Hardly, you can say no, right? Unless market 17,000 to fell to 15,000. In that case, you can't do anything. Even not only you and I, nobody could do anything. Market fell. Don't just consider like only we cannot do. Nobody can do anything. Market all of a gap down 10%, gap down 20%. Market is locked. Does anybody can do the? No, there is nobody else in the world to make anything such kind of a false. But such false happens quite frequently. No, that is the case. You can go to this kind of strategies like this total investment is 50,000. 50,000 in if I calculate, right? So let me say 50,000 is I considering 2%. Like you can say 500 rupees. Let's say 1% is 500. Let's say 2%. So 1,000 rupees. So if you are investing 50,000, you are earning a 1,000 rupees per month. Even just I'm considering this. So 2% if you are earning on 50,000 per month is good enough. But what I'm telling, even you can earn more than that. If you every week, right, you select ATM call. If you sell ATM call, I don't know. Let me rather than I speak, maybe. Am I audible?
17,000 example you can consider.
Yeah,
17,000 at present if you are there.
1 second. Can you hear me?
Yeah.
Hello?
Yes, sir.
My video struck. Let me just want to take a board rather than just it is some reason stuck.
It's okay, sir. If you explain, it's enough. Now, current market, suppose it is 17,000 today, and you are telling us to sell ATM call.
Okay, fine. Let me explain. So let's say 17,000 is a strike. A market is trading around. What one can do? So is a capital is 50,000 is required. 50,000 means let's say one can go to 16,000 call of this is we are in March. Sorry, we are in January. One can go February of 16,000 call. 16,000 call would be costing around 1,100 rupees or 1,200. So 1,200 into 50, which is 60,000 rupees. Right? So today it appears, but if you take a 1,700, it would be around 1,100 rupees. So let me take 1,100 into, one can see NS India also 50, which is costing you 55,000 rupees. That's a debit. You buy 1 month of February. Even currently I am running one trade as well. You can see my Twitter handler. That is there. The trade is there. I'm posting actually deep in the money, 5% deep in the money, covered call or call calendar. I made a title and that is there. So what you can do, you buy that, and on top of that, every week you can sell the option. So if you sell the option, you get a premium of 150 rupees. Plus or minus 10-15 rupees.
What price should be for selling option? What price?
Strike I said ATM strike. Maybe this is my upcoming video. I would explain in detail. But ATM, every time you go ATM, at the money strike, because weekly, yes, weekly 150 around that, right? You would get a premium of 7,500 rupees. We calculate 2% is a 1,000 rupees per month, but here 7,500 rupees per week you are getting. If provided that market stays there or below that. If market goes up, yeah, underlying would go up, you will be in loss in a sold call, weekly call. But if you get a premium of 150 rupees, that strike plus 150 tak, you will not have any loss, literally. 17,000 call you sell, 17,000 into 150, 17,150 strike. Till that, we are okay. Even market close at 17,150 next week by Thursday expiry, underlying would go up 150 rupees. In short call, you don't get any profit, but there you get profit of 150 because that is in the money. So every point is calculated. So like that, not every week you make money, but every month if you see, it gives you more than 2%. I know people, I used to do that. Even you would get 1 point up, I get per month 25%. And even in 4 months would get double the amount. So this is a ideal figures, right? But in this strategy, expecting 2% or 3% is so easy. Only drawback of this is market falls, significant fall, 1,000 points or 2,000 points overnight. That is the big gap down would be causing drawdown. If not, yes, we can make good money consistently every week. I mean, 1 week or 2 weeks you don't get, no problem, but by the end of the month, by expiry, you would get good amount, 2 to 3%, even more than that. This is a safest strategy, low capital, risk defined way.
Entry and exit, can you give approximately when to enter, when to exit in case there is a problem?
See, entry is corrected like anything, like you recently, right? It was corrected to 17,000, 16,800, 16,600. We know the market has been corrected all the way 18,600 to 16,600, 2,000 points. Now, what do you think generally, right, from here, does market correct another 1,000 points, another 2,000 points, or market has an opportunity to gain another 1,000 points or 500 points up? We would get the probability of market would go up only, not much down. That is the case. You can enter buying a call 5% deep in the money and start selling ATM calls. This is an opportunity. Whenever market crash like this, that is an opportunity, because we know that there is nothing bad news in India. Market is in India. There is no bad news. Everything is good. Everybody is posting good results. What happens? Why market would fall down? So we have all the scenarios, factors. We know that. Then that is the case. You can enter. Even market is not 70,400 near to that. Even there is a correction, anything. Maybe again you can go that. Even now also you can go that, no problem. Because more details, and I think I posted in my Twitter. You can watch that trade, live trade, which is going on. I posting every week. I mean, this week I post my result. That is there. Based on the risk and reward and capital, one can take 1 lot or 2 lots or 3 lots. Yeah, you can take. Yeah.
Yeah.
That is a strategy. Best strategy. You can plan about bull put. So bull put is a one thing we can plan. But if a 2% return is, let's say you are investing 1 lakh. Let us say, I mean, you need a 1 lakh margin. If you take, let's say you are asking for 2 lakh. I'll tell you simple formula. Now NTPC trading as 124, right? NTPC closed price is 124.40 paisa on last trading session. What is your expectation? NTPC would go more? Maybe Krishna, maybe you can answer. What do you think NTPC stock would fall more in the more January?
Not much. It will be stable, slightly more or stable. It will be.
Yeah, stable or maybe let's say another 4 points, 120. Okay, maybe it correct. So you are expecting 2% return means, let's say NTPC would take 1 lakh as a margin, we are expecting a return of 2,000 rupees.
Yeah.
What you can do, you can go and short 110 rupees, 110 strike of 50 paisa, or you enter early 60 paisa, you will get it. 50 lot is 5,700, let's say 6,000.
Okay.
That's 50 paisa is 3,000. You are getting it 3% a year itself. Very safe.
Correct.
NTPC would not fall to 110 rupees in by this month, January. So margin is blocked 1,000. You are getting a 2,000 plus, which is a more than 2% or 3%. Fine. What else we want? Because people, there are opportunities. Somebody wants to earn 1%.
It's a naked put.
Yeah, naked put. We call it naked put. In worst scenario, that's assuming that the worst, we do not get that much worst scenario in NTPC correcting to 100 rupees, correcting to
Delivery.
like that.
Delivery.
In case we take delivery, because we have various reasons. Take deliveries, NTPC we don't we generate money from the selling puts and calls. Anyway, they are giving constantly dividend. We will get a dividend. Even if we do nothing, also we will get a dividend. In worst scenario, otherwise 2% return from NTPC. For OTM strikes, you can make money. Just sell the call, sell the put and forget. I mean, keep watching, but you can do nothing. Simple. Yeah. And also you can think about Hindustan Unilever. You can think about some low beta stocks. So 2% return is good for low beta stock. You can think about Marico, and you can think about Reliance Industries.
Okay.
These are the good stocks, low beta stock. You can choose low beta stocks. You can go far OTM. You can make money. Now HDFC is around 2,600. Maybe 2,400 would be trading around that 10 rupees. So 10 rupees is nothing. Even HDFC falling to 2,400, 300 is rare. So like that you can choose and you can plan. That's all. That's as simply as like that.
Yeah, worst comes to us, you would take delivery.
Yeah, so let's say,
sell call.
Yeah, if you take a five such trades, all 5 trades to become in the money, what is the probability? Very rare, right?
Very less.
Unless there is a scenario, rare.
Yeah.
In that case, okay, 1 or 2 fall into in the money, you can adjust it and maybe you can roll down. Without taking delivery also you can manage.
My next question is the rollover cost. What will be the rollover cost for futures especially?
People call it rollover cost. Cost is rollover cost in sense generally futures are included dividend, interest, all together they make a money additional to spot. That is, they call it a rollover. Sometimes you get a strike future price at a discount or same price. In that case, rollover is nothing. Just you can take having liquidity of 4 month. This is January. February you will find it. January and February you can still take a futures. Do not have any rollover cost there. People think roller cost nothing, like just a premium, whatever the trading above the stock, that is something you need to close. Of course, additional charges are there for futures to close, and because rollover means that you exit the position and you can again take the new position. That's how. Whatever cost or loss that are part of the game. I don't know. Some brokers, I think they have option. I think I heard that in ICICI. You can make a rollover to next some series, something like that. Option feature is there, but whatever way, directly, indirectly, that's how it works. You can as simple as close the trade and take new trade again next month. That's all.
Clear. Thanks a lot.
Yeah.
Ganesh, good morning. I think thanks for your time. I think I learned a lot from your YouTube videos. Of course, I come to know through the Ranjit ji Group, yes. I think it's a group of a lot of knowledgeable people. So yes, as a beginner for a trading, so I learn a lot, especially in the options way. I have only the two questions I have. One, let's assume. Okay, I also what you exactly told the previous guest, selling too far out here for a 2% return. That's what I also tried. Not for NDPC, I tried for a gain. I do for a Petronet because I have a holding also. So I don't mind to have that one. I think even the Petronet is selling for a 200, selling for a 1 rupee 1.25 yesterday. So what you were saying, okay, that's also a good one. But my question was, like, if I bought a Hero Honda, I took a delivery Hero Honda at the top point, I think 3,400, 3,500. Now it's 2,400. If I stuck with such a stock, what is the right exit criteria? I should book a loss, or that's my first question. So if you can answer, then I'll ask next.
Okay. So when you took a delivery, Hero Motorcom, right? You mean Hero means Hero Motorcom, right?
Yeah, yes, Hero Motor, yes, around 3,400, something like that.
Okay. Yes. When you took the stock at 3,400, you invested that into for long term or a short term point of view? Or
No. I'm not invested, because when I tried to do the option wheel and I took a delivery, so I tried to do a back test and found a couple of stocks, the Aravinda Pharma and this one. It's fallen from high to low almost 30-40%. So in such a scenario, how to manage the wheel strategy? That's one I want to learn. I don't have any position, but I want to know before entering the thing, so I don't want to stuck.
Okay. I think my first video on YouTube channel I made on for ITC. This is a common question people ask when ITC, right? ITC, somebody entered at 240, 45. Now it is nowhere moving around plus or minus 1 rupee, 2015, 2016. People would ask me this question: what to do? This is I entered at 240, 250, assuming that it would go next day 300, but now it's corrected at 215 and 210. It's going anywhere. I have to sell call also above my sold strike. I cannot sell my call. I don't get any premium. What to do? These are quite a simple, common questions. Yeah, that is a reasonable question too. So if you see a video in detail later also, ITC, how to sell a covered call aggressively below your strike. That is the title. So generally what we do there is, you have to sell below your strike price. Means not exactly, if you say stock Hero Motorcom 3,400 to 2,400, 1,000 points it was corrected. In that case, you cannot sell call at 2,400, 2,500. You cannot sell, or maybe you can sell also. If suddenly stake up move, you will end up with a loss, and finally you hardly earn anything. What you can do, few strikes go down. One can go down few strikes. Let's say 3,400, somebody entered. He can go up to, you can imagine this. Now today is the 2,000, close to 2,500 today, Hero Motorcom. 2,470 or 2,462, 2,800. Chances for to become in the money very rare. 2,800 is very rare. What one can do, he can keep selling 2,800 call few months until it comes to close to 2,800. He would get some money, at least. Some money means not great returns, at least 1% return he can get it. Even if you get a 10 rupees, is a 3,000 rupees, 3%. 10 rupees premium itself is 3% return. He can get 3% return, 10 rupees from the margin money. He keeps selling this 2,800 for a few months until it comes to stabilize to 2,800. Then suddenly it becomes in the money. What one can do? He can do roll up. Suppose if that is the case, he can do roll up. Then he can go to his strike where he purchased. That is one way. Otherwise, it came to 2,800. I don't believe this stock. I don't want to this stock. This is very, very weak stock. I don't want to continue this stock. I have other stock. I know I can invest. Definitely can exit the stock. But after a pullback rally, you can exit and book the loss and switch to other stock. But picking up a stock is the first criteria. Just not like take any stock you like and buy and hold it and leave it. You picking up the stock, selecting a stock is important in option wheel or anywhere in ITC, whatever, right? So fundamentals are good, stock is good. If worst case scenario, Hero Motor Comp is worst scenario, per annum it is giving you 3 to 4% dividend, which is like a FD return, which is like a saving account return. On top of that, whatever you earn, 1%, 2% monthly is an added advantage. So such cases, such stocks, you do not think about more returns, such things. Just think about that you are getting more than fixed deposit. You are earning more than a saving account. That is fine. You can take time. You have to give enough time to the stock to recover, because such stocks will take a drawdown because of market dynamics. Right, EV space, electric vehicle space, unlisted players are doing good, but listed players are not up to the competitive, so they are beaten down. This is a short-term phenomena. Definitely they would come back. By the time they come back, you enjoy the dividend, you enjoy with the 1-2% for OTM call every month. Give enough time if you don't want to book the profit, and hold on it right until it comes to your strike, then you can take a call. So there are several options you can do that.
Thanks, Ganesh. Thanks for a detailed explanation. I have a next question. Okay, now I think I'm planning to, actually I'm testing it. I want your opinion. I bought a Nifty Bees. The other option, or the idea you told me, buy a deep in the money call. Okay, either way. So I'm not initiated. That's what I'm planning to do in the new year. Before my idea was buy the deep in the money, what you say, or buy a Nifty Bees and sell weekly call worth 150 rupees and buy a put downside for a protecting downside, buy a put worth of 50 rupees. So I eventually have a 100 rupees premium. That's I could packet. This is the right approach, because I don't want to suddenly, if the market crashes, big crash for 1,000 points, then my Nifty Bees, or then it goes huge loss. So what is the right approach? Just sell only the call and keep quiet, or spend some money to buy a put? Like what my thought process was, sell a 150 rupees call and buy a 50 rupees put, whatever the strike you get. Leave it, let it go till the expiry. What is the right approach? And for the index?
Okay, index, you already hold one lot of Nifty Bees?
No. The idea was I could buy one lot of Nifty Bees, or what you suggested now, buy a deep in the money call. Either way I can do, but I want to know, selling a call is enough, or I need to buy a downside protection as a put. So my idea was selling for sell strike price for a 150 rupees call, then buy a 50 rupees worth. So eventually I have 100 rupees in my pocket. Let it expire at 0.
Yeah. So okay. There are several ways, right? So if you are giving two options. One option is a moderate trader. What I said is the ATM call sell 150, and you are telling about what if it correct. Yeah, in that case, what you can do, you can buy put for 50 rupees put wherever it is traded. That is where just I want to share screen so that it helps you understand better way. Let me open it. Are you able to see my screen option chain?
Yes.
Okay, fine. Now let's see. today market is around 17,354 as per last session. Now let's go to February contract. February 17, 24 February 22. Let's go to strike.
Ganesh, what I thought is, if you go to the March 24, 13,000 contract, I thought, okay, that was my 13,000, that's have only 20-30 points premium.
How you want to hedge with a 4 month?
I thought, no, actually, I can do month. I thought, when I do a planning, I thought I can go for a March 24th or March 31st, go to by 13,000, because I thought I want to have a less premium. I found the 13,000 have only 30 points premium. So I thought, okay, then it's almost it's a future. So I buy this one for 4,400 or something like that.
Edge is that you need to put edge is a lesser amount, not a more than debit amount. If you go, so see, I'll tell you. Let me explain this way. Let's say February 24. Let's understand this 16,000 call is trade. 16,000 call is trading out 1,516. That is not even 5%, even more than that. You buy, let's say, 16,500. You see, 16,500 is costing around 1,088. You all see, right? 1,000 and yeah, this is 1,088 rupees.
It has approximately 200 point premium.
No, 1,088.
Yes, 1,088. That means the current spot price 1,735. So almost I have a 200 rupees premium, right? All right, I'm wrong.
No. So let me put it this way. I'm going February contracts, okay, and 5% deep in the money from the spot, which is even close to 16,500. Few February contracts 16,500, which is costing 1,088 rupees. This is the one. Let's say you purchase this contract. This is a debit, which would cost you to take this delivery for 55,000. Let's say you pay 55,000. So your maximum loss is 55,000, not more than that. Now, how do you hedge? You say you want to hedge something here, 60,500. Okay. Now this, just remember that this number and February. Now you are into Jan 6th weekly series. You are into Jan 6th weekly series. The current month is spot is 17,350. 17,350. You go 17,350 call, which is costing you 134 because already 1 day is over. So 2 days already over. That is a 130 rupees is premium. Otherwise, you would get around 150 or 160 like that. So you sold 134 rupees. You all see 134 here. 134 rupees premium you sold. This is ATM call. Now, by this week, what if it goes down? The market suddenly crashed. What happens to my 16,500 call purchased? What you can do, out of 134, go down a put where you get 34 rupees put. Let's say 34 rupees. Where are you? Where you get 34 rupees? Around 34. Here, 30 rupees is there. 30 rupees is this week you are getting 17,000 put is available 30 rupees. Srinivas, you are getting my point? You can go hedge this week. Means you are getting 134. Out of 134, you are taking insurance for 30 rupees. That is at 17,000. Within this week, if market crash to 16,500, what happens? You get 134, but 16,500 would become 550 rupees edge here. You're getting my point? So this is how you have to hedge. Hedge is something. In this case, you lose nothing, but you gain at least 2 to 3%, even more than that.
This I organize exactly. This was, but I'm not. I look differently. I thought I buy it 13,000, but what you say is okay, because not spending 2.5 lakh rupees, but what you suggest is say 55,000. Okay, this looks reasonable. Okay, then what my idea was selling for around what 150, 160 rupees when the Thursday expired. Thursday was around 150, 170, something like that. So right. I sell it and buy it for keep a 50, 60 point and keep 100 point. If I do this one regularly, I able to manage 2% without any big trouble, right?
Correct. Even market, you don't need to worry. Market even significant fall, any black swan event happens, it's nothing to worry because you are hedging your position. And also, probability is high, man. Probability is too.
Yes, actually, because I like you, I am also a software engineer. I do a lot of back tests. So my thought process was okay. If it's 17,350, I sold for 150. If I bought for 1,700, then I have almost 200 point loss. For my bad luck, Nifty closes around 17,000 next week. Then I lose 10,000 rupees loss, but then I sell it for in the money call and put.
Hold on, Srinivas. Market close 17,000 by this week. You said you would lose how much?
Because right now 150 point I collected from here, so then I have a 200 point loss, right? Approximately.
Where is the loss? 150. You sell the call, right? You sell the call. 150 is your money.
Yes, then it's out to till 17,200. I have no loss. But if it goes to 17,000, I have my call, the original call I bought February call, that will go down by 200 points, right?
That is where you will be in unrealized loss, not a realized loss.
Okay, exactly. Unrealized. That's exactly unrealized loss. Then if I sell it for next week, okay, then my bad luck, every week it goes to the break-even point and low, then I will be in continuous loss. That's unrealized.
That is where, so if it keeps going down every time, that is where you feel you losing. That's the worst case. That is a case you can take monthly hedge. This is a weekly, right? This is weekly. Let's check for if you take Jan month itself. I mean that's a bit expensive because hedge should not pay more. If you take hedge, let's say 17,000.
Sir, I'm just trying to understand the strategy. So in this case, Mr. Srinivasan is buying the February month 16,500 CE and selling 17,050 PE of this week. Is that
correct?
Right?
Yeah. Okay. So but this Srinivas, so if assumption is like every week it would be correcting 300, 500 points since you enter. That is called a bear market. That is called a significant fall. If that is happening, definitely we cannot do anything. Maybe a little bit hedge will help you. Otherwise, max loss is, we know that 50,000. Not even max loss 50,000 never happened because right, the moment you enter 55,000, you sell a call, right? When you sell a call, you receive a 7,500. So 55,000, 7,500 is 47,050 rupees. So 47,050 rupees, again, if market comes to 17,000, again you sell a call because the volatility is high, you get 170 rupees premium. Then you get again another around close to 10,000 rupees premium. Then your market still goes down in next week. So your loss 45 become 35. Then 35 you sell another call, again 10,000 rupees you get, 35,000 becomes 25,000. Again you sell another call, 25,000 becomes 15. So by the month, every week is falling down, you will lose nothing, you gain nothing. End of the month, you will be You come out without no problem, no loss. Then what happens? You buy next month call again. You don't give up here. That's what you understand. Point here is market is falling and falling. It doesn't mean that keep on falling, right? There is no only direction, right? So then again next month you buy next call. You close the trade. Next month you can buy 15,000 call, which is available again 1,000 rupees. Then you sell ATM call. Keep selling. Then you market takes up, then you get a profit back. So 1 month you lose, next month you gain. Sorry, 1 month you get no profit, no loss. Next month again started gaining, reaping the what you sow. Then you'll be profitable. This is the how you have to think. You think market direction as a 1 year, then you will get a better understanding, not a 1 week or 1 month. This is a business, right?
Okay.
This is a business. You think in a way business. Business is not planned for 1 week or 1 month, right? Business is planned for year and years. Then you will get a profit. Okay?
Yes, Ganesh, I understand, because this was I want to understand, but okay. I have one final question, because this was a plan I want to do in 2022. But the original plan was buying a Nifty beast and do that one. But of course, what later when you explain, I can do the same with the buying a call. Okay, this makes I can save capital. But my final question is, okay, instead of buying February, what if I buy a December 2022?
Yeah, you can buy. It's not like monthly or why not February, why not December? You can buy, but December you would buy. That
but
is
almost its premium is bit high, very high. Definitely yes, it's at around 2,000 or something like that.
I'll tell you, if we go December 2022, let us say 16,000 call premium is trading at 2,375. Right? So it is trading double almost double. Why? So why do you want to pay? Here, I'll tell you. Here, catch is that you have to pay for only intrinsic value. Don't pay more than 100 rupees for extrinsic value. This is not a business. That is not a profitable for business. I'm not sure whether you get my point. You pay for the intrinsic value. You don't pay more than 100 rupees for extrinsic value. If you take a December 16,000 is trading at 2,335, which is 1,000 rupees, more than 1,000 rupees is for extrinsic value. Why should I pay for 1,000 rupees extrinsic value? I don't want to pay. I don't want to pay for that. So if you plan like that, you will get a premium around 1 or max 2 months for, you would get only striker premium, which is only intrinsic value.
Okay, Ganesh, I think from your thought process, if I understand correctly, optimization, utilization of capital is very important, right? That was from our understanding. If I 1.2 lakhs, I sell 2, buy 2 February and sell 2 calls to maximize my profit. That was the thought process?
Yes.
Okay, thanks a lot. I think this is the planning I did. Okay, this is a plan I want to do, but yes, I want to get some clarification. It's always get it from the expert. What are the issues? But yes, of course, if I don't spoke with you, then I do with something like December with a high premium, like RPI go to too deep in the money for spending 2.5 lakhs. That's not a right capital utilization on the return. Okay, what you are suggesting is better. Okay, I think I will try. I think Monday I will going to do the same thing what suggested. February or March, wherever I could get a decent premium paying around 1,100 points and do a monthly. I'll try for next 2 months and I'll update you how it goes. Thanks for your time, Ganesh.
Yeah, Srinivas, have a look at my Twitter handler on the this trade. I posted trade as well. I think, did you get a chance? You can see the sample.
No. I follow you everywhere. I follow your YouTube. I follow your Twitter. I follow you. Yeah.
that makes you more understanding. That's a live points and everything. You understand that better. But later I'll make a video deep in the money December series buying and all. There is a one other concept that is I will explain that some other time. That is a cover call. We can do that deep in the money. That I would explain some other time.
Oh, okay, Ganesh. Thanks for one after topic question. You are in the cloud administrator or something like the AWS. Where you are currently posted in Kerala or somewhere else?
No, I am from Bengaluru. Actually, I was working as a cloud ICS, Oracle Cloud Integration.
Okay, you are in Oracle. So I was working in AWS Cloud. Of course, I'm working in Gurgaon, but I work in AWS platform.
Okay.
Yes, I thought you could be that. Okay, that's after. But yes, very extremely you are knowledgeable. I am able to get the first beginning of the year. I want to do. That was my plan. I want to do index option wheel. Try to make 2%. That was my plan. But yes, after you talking, I have a couple of more ideas. But I will execute and update you my trade status. Thanks for your time. Thank you very much.
Yeah, always understand there is no only single strategy work for all the time. So based on the time and market sentiment, we keep switching different strategies that we are comfortable. Based on that, we make adjustments. So we make take a decision better one which suits to that time.
So this put buying is only for hedging or for reducing the margin?
No,
I think without buying the put also.
That is for buying is for hedge. Yes, he was asked for a hedge.
So the
otherwise is not required. You can simply control with
because that is a buy already. It took already a long month contract buy debit, right? So it doesn't need any margin benefit is not required because buy is there when you sell a call, margin benefit is already there. Additionally, that to hedge if a market fall 1,000 points from that to protect is buying hedge for around maybe 10%, 15% of the premium received.
Means you are ready to lose the small percentage of premium what you have received for the sake of hedge.
That is a hedge, yes. So that is for a more conservative investor. If you ask me, if I was there, I generally I didn't want to do that because I know my view is that market from here doesn't take much fall. It would take a little bit correction or neutral or bullish. In that case, I don't take edge. If I feel market is very uncertainty is going to happen, many things, then maybe I will plan for a hedge. Based on market sentiment and condition, we take a call.
Sir, that buying put is on top of the buying FAR ITM call and selling the ITM call.
Correct. So
okay.
Yeah, buying
three legs.
Yeah, basically two legs. Ideally, 2 legs are important. Additional 1 leg is to even in case worst of something what happens 1,000 points gap down 10% gap down. What to do that? That is the point. Then buying 10 to 15% of premium received, premium available at put side, you buy it. Generally, yeah, it depends on the perspective, but yes, I thought that also we can write the trade in case, because anyway, maximum is a risk defined, right? Is a 50,000 or 40,000 last max profit. We max loss we get out of this trade. In that case, we have nothing to worry much, right? So 40, 50,000, if you are worried, what if you lose? Then yeah, that's what you have to think about that.
Okay. Sir, and I was just looking at your Twitter, and on 23rd December, you have posted that Nifty call calendar setup.
Correct. Exactly.
You're referring to the same thing, right?
Yes.
So I just did the Opstra analysis, and I see that the risk to reward is 1:0.06 for this. Are you choosing this because there is a high probability, or?
If you Astra and all, if you put a different calendar spreads, it doesn't give you exact risk reward ratio because it doesn't understand. They don't have the analyzer for 4 months and current month. This is a calendar spreads, right? They cannot compare exactly because whatever loss they're showing is what you call. I think there is a video I made on the call calendar spread, specific video on that. Not mislead people who look at that risk reward. They based on that. They look at that because see February you buy a February, but it will calculate based on the current month risk reward. So how is that February month premium would become 0? Never, right? Hello?
Yes.
Can you?
Yes. Yeah.
So after is taking February month premium would also become this month itself 0. So is it really become 0 this month?
No.
No, right? There is extrinsic value, right?
Yeah.
Extrinsic value will never become 0. So it would take everything will become 0. Then they would calculate. Then based on that, it gives you risk reward, which is not true actually. That's where calendar spreads cannot be measured from the Avstra or any other tools.
Okay, sir. Thank you.
So, any other things? If you people do not have any questions, maybe I will share my one watch list, 2022 watch list. I have some shares. Maybe you can understand better some list final touch. Unless you have any other questions.
No questions.
Okay, all right. Let me share quickly my screen. That is. Are you able to see my screen?
Yes.
Watch list 2022, right?
Yes. PowerPoint slide, yes.
Okay. So people would ask, right? I told you that first point is your stock selection is your first point. Which stock you need to choose at all? You have to choose all weather stocks, not seasoned stocks. You first plan to all weather stocks, and you have to stick to safety of margin. That is the important. So how safety of margin it would give you as a cushion in case of market downtrend. So in the list, these are 15 stocks. As per my watch list, I prepared this one. So you can think about this. If your portfolio is good enough to choose this list, then that is a fair enough. Means Reliance Industries is a sector wise close price, whatever I given. So list is 15. In year 2022, I'm expecting these stocks would give you good returns and good cushion and a good safety of money, safety of margin, and a good up move. Reliance Industries, I quickly read it out. Reliance Industries, Infosys, SCL Technologies, ICICI Bank, State Bank of India, Cipla, Dr. Reddy's, Ultracement, Hindustan Unilever, Marico, Asian Paints, SBI Life Insurance, HDFC, Larsen Toubro, and Maruti. So these are 15 stocks. If you let's say you think that, oh no, why didn't you choose TCS? Why didn't you choose HDFC Bank? I don't mean those are wrong. These are the certain parameters. I feel these are the stocks going to do well in upcoming months and years. On this, anybody have any questions on this list or would like to ask anything?
Ganesh, this one, okay, this portfolio, you can do a CSP or covered call, right?
Yes, this all type of trades can be done. All weather stocks, investment, trader, optional trader, all this, anything can be applied on these stocks.
Okay, thanks.
Sir, TCS is not on this list.
It has everything. So you say I'll tell you, all are large caps and risk-wise low risk. It comes under risk profile is low. All of them is low risk.
Okay, sir. Okay.
Okay, I think that's all from my side. So you guys have nothing, then we'll close.
Thanks, Ganesh. You've given a wonderful New Year gift. I think at least in the way of your knowledge. Yes, I gathered a couple of doubts I want to do in 2022. You clarified everything, but I think one point I take away is capital optimization is the key from your thought process. That was not in my mind before, but now I know. When you say capital, then I can do multiple lots and optimize my return. I think that's was a takeaway. Fine, biggest takeaway for me.
All right. Thank you. Thank you all.
Thank you.
Thank you, sir.
Nice
Thank you so much, sir.
Thank you for giving me that.
Thanks, Ganesh. Please organize such a thing at least once a month or twice a month. We will get together more knowledge.
Yeah.
Thank you.
That's a plan. Maybe once in a month or just we can have quickly wrap up meeting. We can have no problem. Huh? All right.
Thank you very much for giving me that short 1% interest. Earning 1 to 2%. What I was asking strategy. It's really very interesting. And other than that, Ranjit had given our option wheel, and this. I think these two are. I think the New Year gift for us. Thanks a lot.
Thank you. Thank you very much. Bye bye.